All right, everybody, how's it going? So this is the second part of the insurance stock series. Please watch part 1 for the first 7 stocks, but also because we cover and go over the metrics that are vital for evaluating the insurance business. Now, in this video, we're going to be going over 9 more insurance stocks, with one being a hidden gem and one being an absolute monster, a dividend compounder with cheese. And at the very end of the video, I'll also be going over my personal buy price for the ones that I like the most. So without further ado, let's go ahead and get into it with insurance stock number 8, I believe it is. And that's going to be American Integrity Insurance Group, ticker symbol AII. I know, at first it looks like all, but it's AII. And they were founded in 2006, but they just IPO'd in May of this year. So they're relatively new. We don't have much data to work with, and they do property insurance for Florida, Georgia, and South Carolina. Now, if you are a friend of the channel that's from Singapore, Switzerland, Germany, what you have to know is those 3 states are in a Gulf coastal area where it's a region known for their risks associated with hurricanes. And a hurricane usually wipes out the entire city and a zip code. So a pretty risky client base to cover. And as we take a look at this startup, their net income per share is $3.19. So it goes to show you, just because you are a startup does not mean that you have to be unprofitable. If you are good with your books and you have a good strategy and a good business model, you can be profitable as an IPO, for instance. Now, obviously, they do not pay a dividend, and we can't really measure the total return in the stock market for them. Not much data to work with, but their PE, price to book, and ROE combination looks pretty darn bright, because this number is closer to 1 than it is to like a 3 or a 4, and their ROE is at 26%. Dude, they are really profitable and are doing really well with their business. But as you can see by their trading multiple of a 5, I think Wall Street and other investors are kind of fearful of going near this company. Now, unfortunately for American Integrity, I do have to adopt herd mentality because it's just really risky, their client base. But their numbers look pretty good. With that said, this is one of those things where it's like high risk, but really high reward, in that they're posting really good numbers and their fundamentals and metrics look phenomenal. But it's like, if there is a really big hurricane that wipes out Georgia and Florida, dude, their net income is going to be depleted. So keeping that in mind, I do think it's still way above average. Like, if I were to invest into American Integrity versus Prudential Financial, every single day of the week, I would pick American Integrity. So with that kind of mindset, I think I'm going to go with a C plus for now. I'll tell you this right now. If their price to book ratio was under a 1, then I would have bumped this up by a whole letter grade or even into the A category. But because it is a 1.8, we'll just leave it as. The next company that we are going to cover is the Selective Insurance Group, ticker symbol SIGI. Currently trading for about $86, and they are a lesser known do-it-all insurance company that's been around since 1926. Dude, that's crazy. Almost 100 years of business history. And as we take a look at their dividend profile, it's nothing to write home about except their dividend growth rate of 10.4%. Sign me up. I like that. Whenever I see a company have a double-digit dividend growth rate, I don't know why, but it just makes me happy. Whether or not I'm invested into them, it's like, dude, for the people that are invested into them, that's good ROI. I know Domino's Pizza and Texas Roadhouse are some of the other ones that also have a double-digit dividend growth rate. But coming back down to the insurance stocks, their performance, not bad. It's okay, 8.4%, just average. And their book value per share is growing 10% year over year. It's pretty good. But as we assess their PE, price to book, and ROE combination, weaker fundamentals here. It's too low here, a 7.4%, not a big fan of. And upon further review, I found out that their net income dropped by 40% recently. Remember, if the net income shrinks, then the ROE is also going to shrink. And that's because there were more auto claims than they had anticipated for the past 365 days. And this goes back to quality underwriting. If you have a team that is smart with how you assess potential customers and their premium bills, they wouldn't have been slapped by this issue. So it just goes to show me their underwriting strategy is not too good, but also because of reserve strengthening. AKA, because of that, they're anticipating that payouts and claims in the future will also cost higher than they had forecasted. So it's them shooting themselves in the foot and then reversing that damage and doing damage control. So their net income and their profitability went down by a lot. 40%, that's a lot. However, all that to say, their performance is still decent, it's okay, and it's still growing, and their dividend growth rate is 10%. But between you and me, I feel like this is just a one-off instance. Like, this is not going to be happening year after year after year, because looking at their fundamentals and financials, I mean, every single year seemed to be okay up until this point. So I think they just got a little too greedy or a little too optimistic. And so for me, I think they're going through a temporary storm. So all that to say, I think this is a C+. I think they're slightly above average, but if this trend gets worse or it repeats year over year, definitely in the D category. So C+ on the basis that this is not going to happen next year, that their net income is going to be normal again. And the next insurance stock is going to be Berkshire Hathaway. Dude, their Class A shares are almost $1 million. I think it's like $700,000 a share. So instead, we're going to be analyzing the Class B share, which is ticker symbol BERKB, currently trading for about $477 a share. Their earnings per share is $37. That's pretty darn impressive. And Warren Buffett is absolutely a hypocrite because he's like, oh, I love dividends, but his business does not pay a freaking dividend. He's one of those people where it's like, do as I say, but don't do as I do. So they don't pay a dividend, so that is a point against them. However, their performance in the stock market, they outperform the S&P 500, 11.2%. And for their tangible book value per share, we had to use the numbers for the Class A shares. And that's why it's almost $500,000. So their book value per share is $450,000. That is absolutely bonkers. And what's crazy to me is this valuation grew year over year at a rate of 17%, and their metrics and fundamentals, the PE, the price to book, and the ROE combination, it's pretty darn solid. Because you have to keep in mind that they're not just an insurance conglomerate. They also have a railroad company, Dairy Queen, and Brooks Running Shoes. So taking all of that into account, still posting a 13% ROE, I'm pretty impressed. So Warren Buffett's company is gonna be an A. It's a really good proxy for the S&P 500. I know there's people out here where instead of investing into SCHC or VU or a SPY, they invest into Berkshire Hathaway because within it is little America. They have almost every business segment represented except the tech space. Do they have an AI or a tech player or a semiconductor chip manufacturer? Other than that, I think it's a pretty well diversified ETF. It's not an ETF, but it basically is an ETF with how many businesses are operating under the umbrella of Berkshire Hathaway. All right, friends and family, the next insurance business is going to be the Reinsurance Group of America, ticker symbol RGA. So they're in the business of providing insurance to insurance companies. I don't know about you, but to me, that feels a little less risky because they're not having to deal with 100 or thousands of different little claims and payouts for thousands of different customers. They're usually only working with like 5 or 10 clients. But on the other side of that argument, I suppose if there's like a major event or a catastrophic disaster, yeah, that'll drain their float and deplete their net income pretty darn fast. So I guess they're still risky at the end of the day. And as we take a look at their numbers, their net income per share is $11.84. Pretty good. Dividend profile, nothing to write home about. Their performance, dude, 12.3% year over year. That's taken into account the share price appreciation, or in the context of Hippo and Lemonade, depreciation, but also the dividends that are paid out. When you combine those two and you marry them, it's an arranged marriage, whether or not you love each other. By the way, I found out in communities and cultures that do arranged marriage, they usually have a higher success rate of the marriage lasting and happiness. I don't know. I'm not a huge fan of the whole idea of an arranged marriage, but it gets even better because their book value per share is growing year over year at 26%. So not only do they have a beautiful performance in the stock market, but they're also posting a delicious growth rate of the worth of the company, of what's on their books, the float, the assets. Dude, What's not to like? And as we take a look at their combination ratio, that's not what it's called, it's just what I call it. It's kind of average. So it seems like the numbers kind of fizzle out here. I mean, I love the fact that their price to book ratio is close to a 1, but what I don't love is that the return on equity is not at least 10%. If it was at least 10%, I think for me this is a no-brainer that it would be A or even in the S tier. But because of the fundamentals being weaker, we're gonna have to go with a B minus for now. And the next insurance business is going to be the Aspen Insurance Holdings, ticker symbol AHL. They provide specialty insurance for plastic surgeons, dentists, and they even do reinsurance. And they operate their business worldwide. However, what's kind of weird is that they IPO'd in May of this year, even though the company has been around since 2002. Currently trading for about 29 bucks. Their net income per share is $5.84. Because they just IPO'd, we can't really calculate their performance in the stock market, and obviously they don't pay a dividend. Their tangible book value per share. Now this is where it gets a little sticky because it decreased year over year by 23%. For me, that's a red flag. So I did some investigating to find out what the heck is going on with Aspen, and their net income dropped by 23% year over year. And that's because in Q1 of 2025, they reported a significant increase in catastrophic losses, totaling $91.4 million related to the California wildfires. That's a huge payout. I think that was their reinsurance portion of the business. And that kind of sucks to see. $91 million loss. That's crazy. But as we take a look at their fundamentals, I think this is beautiful. It's close to a 1, and the ROE is pretty darn high. So even though they took a huge hit to their net income, they still generated a 13% for their return on investment. However, taking all of the factors into account, how they just IPO'd, how their net income got demolished, and their book value per share went down by negative 23%, I think this is one of those turnaround, rebound plays. I feel like right now they're in a storm, they're sailing through, and they're trying to overcome a huge wave. So if you can look past that, maybe a B. But for me, taking the facts into reality, I think it's a C. Because they just IPO'd, it's one of those, show me, prove it to me that you are resilient, that you're gonna bounce back from this, and that you're going to do well. Like if they can grow their book value per share in the following year, if they can keep their ROE in a range of like 18 to 20%, happy camper. But if the numbers stay down here and they're depressed and they can't find a way to bounce back, that's why they're a C. I still think they're average, but I definitely think there's better opportunities and better insurance stocks on this list than Aspen. And the next insurance company is going to be the Hamilton Insurance Group, ticker symbol HG. It's a very similar business model to Aspen. They do specialty insurance and reinsurance for customers all around the world, and they just IPO'd in November of 2023. And as we take a look at their numbers, obviously I'm not going to take into account their stock market performance. They've only been around for like a year and a half, but their tangible book value per share growing at a rate of 27%. Chef's kiss. That's beautiful. I think that's really good. Is there anybody that was better than them on this list? 27%, oh yeah. Allstate and Progressive, almost 50% growth rate of their book value. But as they say, comparison is the thief of joy. So I don't want to take away from the fact that Hamilton is posting 27% growth rate. I think that looks pretty darn good. And as we take a look at their combination, guys, a 22% return on equity, and their price to book ratio is less than a 1, and their PE ratio is a single digit. Guys, this is the definition of what I was talking about. I think this might be the hidden gem. I think on paper, they look absolutely undervalued to me. However, because their history in the stock market is so short, it's just one of those things where it's like, I don't know what their battle scars look like. I don't know what their history looks like. I just wish there was more data to work with. But the data that we do have, I mean, let's take a look. Total revenue growing at double-digit rate year over year since 2020. Man, this is really good. Holy smokes. Okay, what about the net income? Has it been consistent and steady? Wow. Prior to their IPO, they used to be unprofitable, but they seem to have figured things out because in 2023 and onwards, Pretty darn good bottom line. Let's take a look at their balance sheet. What I'm looking at here is their tangible book value per share growth year over year. So the valuation of this company, the assets that they have in their float, growing year over year, I think it's pretty darn good, guys. I think this is a hidden gem. Now, I could absolutely be wrong, but I do think this is some good value right here. This is what would make Warren Buffett's nipples, if we were to zoom back like 50 years, if he were to have found this company back in the day, I am certain that he would have wanted to just buy it out and acquire it. I think their numbers remind me of another IPO startup that we talked about, American Integrity. It's pretty similar, right? The return on equity is also 20%, 20 plus percent. Price to book ratio, I guess Hamilton is just better pound for pound. So taking all of that into account, I don't like to do this with companies that don't have at least 5 to 10 years of history to work with on the stock market. But I think the numbers paint a compelling story here. I think they're a B plus, or dare I say A minus. I think I found a hidden gem. My goodness, I can't wait to talk about the price prediction and inherent worth later on, but Hamilton Group. The next insurance company is going to be the Kinsale Capital Group, ticker symbol KNSL. They are a specialty insurance company that focuses exclusively on the excess and surplus market in the United States, the E&S. They were founded in 2009. What exactly is that? Who are their customers? Think of the folks that are denied from every other insurance company. So, demolition companies, roofing contractors, trampoline parks, nightclubs, and the list goes on and on. Customers that generally have a higher risk profile. They will go to the Kinsale Capital Group to get their insurance. And as we take a look at their numbers, folks, this is really freaking good. Their dividend profile, nothing to write home about. A 0.1% dividend yield. Who are you? Google? Who are you? Nvidia? I'm kidding. But they are at least growing their dividend at a rate of 10% year over year. We got to give them a round of applause. I like to see that. 10%, thank you, sir. Their performance in the stock market, dude, I'm about to lose my hairline. A 26%? Are you kidding me? Is this real? 26%? So as we take a look at their adjusted stock price total return, past 1 year is 30%, past 5 years, 200%, past 10 years, 2,600%. Friends, family, this is not an AI chip company. This is an insurance business. Didn't I tell you that the insurance business stocks are some of the best performers in the stock market? Dude, this is ridiculous. So their total return looks pretty good. Their book value growth is 45%, also really good. And as we take a look at their fundamentals, the metrics, the combination right here, the price to earnings, the price to book, and the return on equity, really freaking good. I mean, there's high expectations because the price to book is a 7, but the return on equity backs it up, almost 30%. I think this one goes without saying. If you disagree, there's something wrong with you. You're the type of person that just wants to argue with everybody. Even when the sky is clearly blue, you're gonna pull down your pants and be like, no, it's green. You're one of them. I think that Kinsale is obviously an S, and this is the dividend compounder with cheese that I was referring to. So freaking good. And the next insurance company is going to be the Everest Group, ticker symbol EG. They've been in the business of insurance and reinsurance since 1973. And as we take a look at their numbers, the dividend yield is finally a good one at 2.3%. Growth rate is 10%, just like Kinsale Capital Group. Their performance in the stock market is just decent. Their growth rate of their book, 9%. What is going on here? And the return on equity is 6%. Okay, so I did some researching and some homework, and I found out that they usually do post a very solid return on equity. But right now, it's way below average, especially against the competition, because their earnings per share and their net income just got absolutely hammered. So in Q1 of 2025, their net income went down by 71%. It went from $733 million in Q1 of 2024 to just $210 million this past quarter. That's pretty darn bad. And the reason being is that they had catastrophic losses amounting to $472 million because of the California wildfires. So they lost a lot of money because of that event. That's just pretty crazy to see. Similar to some of the other ones that took a huge hit on their bottom line because of natural disasters that happened in the past year, I think Everest Group is unfortunately pulled into that rebound and recovery insurance category. However, I do think they're decent. It's just the numbers right here, their combination is just it's not acceptable for now. So with that said, I think they're a C+. I do think they're slightly above average, but had that event not have happened and their float and their net income stayed stable, this would have been an easy B+. But as the facts are, they are a C+. And the last company that we are going to cover is Slide Insurance Holdings. It's a startup insurance company that was founded in 2021, and they IPO'd in June of this year, past few weeks. And they offer property insurance in Florida and South Carolina, a very high-risk region because of the hurricanes. They do about 99% of their business in Florida. And as we take a look at their numbers, this is proof in the pudding that just because you are an insurance startup, it does not mean you have to be unprofitable, because their earnings per share, their net income per share, their bottom line per share is $10.88. Obviously, we don't have much data to work with, their stock market return, but their tangible book value per share growth year over year is 136%. Dude, that is just absolutely crazy. And as we take a look at their combination ratio, dude, this is textbook definition of undervalued, like finding gold at the beach. A 62% return on equity? Are you kidding me? And the price to book ratio is a 0.38? Their PE ratio is a 1. A single digit of a 1. I think what's happening is Wall Street and other investors are just not aware of Slide Insurance. I think they're flying under the radar. They are a sleeper posting ridiculously good numbers. Or they are cognizant of Slide, but they're just not piling their money into it because they only have 4 years of operating history and 99% of their business is in Florida. Super risky. However, in my opinion, I still think, based on the numbers, I still think they're an S. This is a really good insurance business. What am I missing here? If you know anything about Slide, if you live in Florida or you do business with Slide, please let me know. What am I missing? Because I think it's an S. I think it's an S. So before we move on to their intrinsic valuations and how much I would personally pay for the best ones, let's just review the numbers now that we have all 16 filled out. Prudential Financial, C-, Travelers Company an A, Chubb Limited, Allstate, Progressive, Hippo, Lemonade, American Integrity, and then we got Siggy, Berkshire Reinsurance, Aspen, and Hamilton, Kinsale, Everest, and Slide. So those are the 16. And out of the 16, only 2 are just straight up doo-doo, with the worst of the worst being Lemonade. If you are invested into Lemonade, like, what's the investing thesis behind them, dude? Their numbers are atrocious. Let me just increase the size of a mouse right here. That way it's easier for you guys to see. With all of that said, here are the best of the insurance business stocks. My least favorite is probably Hamilton, and my most favorite out of this entire group is probably Progressive and Berkshire Hathaway. And what you see right here, this column, is the fair valuation, how much they should be valued at and trading for. For most of them, they're not. And on the right side, this is my personal buy price. I would be happy with buying into any one of them. But if someone were holding a hammer to my nuts and was like, you can only pick 2, that would be a tough choice. But as I just alluded to, I think one would be Berkshire Hathaway, and then number 2 probably would be Progressive. But if I could squeeze in one startup into that mix, it would probably be Slide. But out of the 3, the one that I want to invest into the most is Berkshire Hathaway. If I can snag them at a price point of $4.20 a share or less, I would be pretty happy. So that concludes the insurance industry ranking video. What did you think? What's your takeaway? What are your favorite insurance stocks? Which ones are you already invested into? Which ones would you avoid? Do you disagree or agree with my assessment? Let me know. I love the engagement. I love when you guys comment. With all of that said, I love you. Stay safe. Good luck in the stock market, and I will talk to you next time. Peace.